In Investing 101, the Fed came to the rescue right at the start of the pandemic by using its monetary strategies to prop up the economy. Let's find out what it will mean for the stock market and investors when the Fed begins to pull back and let the economy just run. Joining us now is John Bever, president at Phase 3 Advisory Services. Hello to you, John. And do traders and investors want the Fed to begin tapering?
Yeah, so I really think that investors are looking for the Fed to taper. Most people have the feeling that the Fed has done too much this time. They've gone too long. What they did at the beginning was certainly appropriate back in March of 2020, but everybody feels like they've gone too long and they need to taper. So I think that's not going to have too much of an immediate short-term effect on investors. Traders will probably exit here. But tapering always then leads to quantitative tightening, and that's where the market can run into trouble maybe next year.
Let's just take a moment and explain exactly what tapering means.
So in order to understand the taper, we have to understand the first part, which is quantitative easing, and that's putting money into the financial system where the Fed buys bonds. And they did this after the financial crisis, and it's actually a good thing. So quantitative easing, putting money on the table. The taper is the process of slowing putting money on the table. They don't just stop, they slow the process. That's the taper. Then what comes after the taper is actually the quantitative tightening, where they take that money back. And that's usually where the market runs into trouble. In the talk of the taper, maybe the market stalls a little bit, but when they actually start tightening or get close to that tightening, that's where the market can typically go through a decline. And then the Fed has to manage the downside, and they usually do that through kind of talking the market through the process of the tightening.
What do you think investors should be doing with their money? What are you doing with your money here?
So investors right now should be cautious, and it really depends on their time frame. Any money that somebody needs in the next 3 years clearly should be out of the market. This is the time to pull it out. We've had a nice run. The market is actually about 15% above trend right now, and that trend goes all the way back to the end of the financial crisis, actually the bottom of the market in 2019. So the market is clearly extended. Valuations are pushed. Any money that people are going to need, even in 5 years, they might want to consider taking that money out of the market. Short-term traders, there might be a dip here that they can buy and then play the market back and forth, but investors really should be lightening up.
So is it a good time to sit on the sidelines for a bit and come back at a later time?
I think there'll be a little bit better opportunity sometime within the next year to year and a half. If history is any guide, whenever the Federal Reserve goes into the taper mode, the market does have a problem. And usually drops a minimum of 10%, sometimes as much as 15 or 20%. In 2018, we had that Christmas crash where the market had a terrible Christmas Eve, the worst one ever on substantial volume. But don't worry, the Fed will come to the rescue if they feel it's dropped too far. They did that in 2018, right after the Christmas crash. Jay Powell had some kind of a magical appearance before the market opened the day after Christmas, said some words, and the market took off again.
Who knew that worst moment was actually a screaming buy signal? Thanks so much, John.
You're welcome. Always great to be with you, Angie. Appreciate it.
Go to businessfirstam.com for where to see our show on TV.